right, hold on. Let's put. All righty, we should be good to go now.
Yep.
So the first question I want to get into today is talking about the debt ceiling, and currently that the agreement that they had would have an unlimited cap on it until 2025. What are your thoughts on that and the effects that that would have?
Yeah, I mean, there's a lot of commentary back and forth. There's all kinds of opinions out there. I'll just go back and point out that what is the point of a spending cap in the first place? It's to basically reassure your your citizens and to reassure investors that you are fiscally responsible and that you are trying to limit the amount of your spending. The fact that we've gone through this process, I don't remember the exact stats. So something like 81 times since 1970. I don't know the exact number, but it's like how many times does this debt ceiling issue come up? In my career, this is like the third time where it's gotten to like the crisis point where it's like, oh, we could default. Of course, 2011 was the last time it got to the really stupid levels where we're at here. So, the fact is this keeps recurring, and it just undermines the whole concept of a fiscal of a debt spending cap. Like, if you continually run into the limit, it means you're not actually making any progress in terms of reducing your spending. You're just increasing your spending every year. You're increasing the debt limit so that you can keep that increased spending without making any effort to reduce it. Um, and I mean, you can see this in the federal debt, the U.S. federal debt at 31 trillion. The expectation is now that the debt ceiling cap is going to be removed. Well, it may be removed. We'll find out. Um, we could get to 35 trillion in 2 years, perhaps even quicker than that. Or it's really kind of asinine to me. But I mean, I'm going to preempt probably further questions. But all this means to me is like, yeah, here we go again. This agreement was made basically under duress at the last minute. Janet Yellen claimed that the Treasury would run out of money by June 1st, and then June 5th at the very latest. Dollars to donuts. She had other accounting tricks she could have used in case disaster was going to happen, but it's always the same scare tactic. It's like, you guys got to get an agreement. Well, why does it take till the very last minute to come to an agreement? And then if you actually look at what's been proposed, it's basically cutting nominal spending by like 0.2% of a GDP, which is nothing, and basically no spending for this, no new spending for this year, and then 1% spending for next year. But because of inflation and all that, you're basically going to be spending more than you were spending prior to the debt ceiling agreement. So it's just McCarthy really looks like he's caved in here. It doesn't, he's trying to promote, we're making cuts in you know like, oh, we're making it more, we're having this thing where you have to do um, more means testing to see if you can get food stamps. It's like, yeah, okay. Oh, we're cutting 25 billion from COVID spending. Well, that was money that had already been authorized and wasn't used. It's very, he's trying to make a big deal out of a really unimpressive agreement. So what is this like? We can get into all the connotations, but do I actually think this could get passed? Because it has to go to the House tomorrow. Um, I suspect it won't be an easy pass in the House. I mean, the Senate might be better, Democrat controlled majority, but the House is a different story. There could, and even in the Senate, there could be Democrats that for whatever reason think it's a bad deal. So the fact is, this may or may not get passed. If it doesn't get passed tomorrow, then that does call into question whether the U.S. will default. As it runs out of money on June 5th. I swear, though, that Janet Yellen will have something up her sleeves to get her to June 15th, and that's when the next tax receipt payments come in, supposedly, which would be another 150 billion or so. But the way they're spending money, I mean, 150 billion doesn't go that far. So yeah, I mean, it's a big mess. I don't think it really was a very impressive, like, for all this pain and anxiety that has been inflicted on the news and on us. Did McCarthy really accomplish anything? No, and that's why I think that the vote won't be easy. But even if it is, then yeah, what does this mean? I think that's probably your next line of questioning. So I'll stop there.
Well, yeah, and that's the thing. I mean, even if this does pass and the spending gets out of control, they're going to have to issue more Treasury bonds, and that's the thing right now. The Treasury general account is basically tapped out, like you were saying, and what they're going to want to do is make it so there's demand for those Treasuries, so they're going to have to raise the rates. And with that saying, with that back in history, generally what happens when the Treasury account gets low like this is the market will crash to put demand for those bonds. Do you see that happening this time again as well?
Well, yeah, it's all very interesting. So yeah, the idea is that, as you said, the Treasury general account is near zero. They're, as I said, they do have money coming in as of June 15th. So whether they need to raise, the number being tossed around is 900 billion right away. That may or may not be true. It may be that they have a lot of payments they need to make by then. But yeah, the consensus is they'll have to issue a large amount of Treasury bills very quickly. And the interesting thing is, why Treasury bills? Why not longer dated Treasury notes? And the idea is, well, this is all just short term stopgap funding. Well, we can worry about the actual term of the debt later on. But I think the bigger point is that with interest rates where they are, and even long term rates are very high, the last thing you want to do is get locked into issuing a crop load of new Treasury debt at significantly higher rates. And if you do think the U.S. economy is going to crash, then you want to basically issue short dated debt so that when you roll this over, you can issue it at a lower rate. So yeah, like as you said, they're going to have to make this attractive. So yeah, here's the thing. Typically, what has been the case, especially as the Fed has been, quantitative tightening, is that demand for treasuries has been decent because there wasn't a lot of supply out there. And you've also had the issue where treasuries are still the best collateral you can get. So there's going to always be demand for collateral, even treasury bills, because it's basically got no haircut. You can basically buy treasury and then you can use that as collateral to make other investments and take out loans and margin and all that other stuff. So this is it's interesting. Just that, yeah, like so they're going to buy issue 900 billion, and they're going to expect people to buy it. And then again, as you said, they're going to have to make these attractive. So they're going to have to, there's always a discount when you issue treasury bills. But yeah, like they're, I don't have my money market rates up here, but just looking at 10-year, I mean, we know the curve's inverted. So and Fed funds is at 5%. Treasury bills are going to have to issue. They're going to have to be higher than Fed funds. So what are they going to be at 6%? How cheap do you need to make these to get the people to buy them? It's okay. So where are you going to get the money to buy these treasury bills? Yeah, I mean, there's already a lot of money sitting in money market funds that have come from banks. So the first question is, does this juicing up in T-bill rates cause more deposit flight from regional banks? And it probably will. So that's one stress on the system. And then you've got I just made a crop load in Nvidia, and I think this thing is overpriced, and I'm going to take profits in Nvidia, and I'm going to go buy T-bills. Who knows? I mean, you could have any kind of scenario where people are looking at their investment saying, "Yeah, I made a great deal on this thing, but it's done," or I've been in this shitty stock for 2 years and it's not paying anything. I'm just going to get out and get into T-bills because hey, that's the short term. Or I don't know what's going to happen with this Ukraine thing, and Ukraine's a counteroffensive, and this is going to escalate risk. Oh, I want to be liquid, so I want to go. Yeah, you can find any kind of like rationales as to how this is going to play out in terms of what they're going to justify to sell assets. But yeah, the expectation is whether it's moving money out of bank deposits or whether it's selling equities, or whether it's even taking a hit on liquid but like underperforming long bonds and buying T-bills. There's all kinds of scenarios where there's going to be a lot of selling going on at the same time, which causes a crash, basically, as you're saying, too many people exiting the doors at the same time. Now, this is what the common acceptance is, like, oh, the Treasury's going to need cash right away. They're going to drive the markets into oblivion because they're going to force people to sell their assets and buy T-bills. Well, they're not. No one's forced to buy the T-bills. It's basically what price is cheap enough that people will want to sell stuff. And does that happen automatically? And again, does the Treasury need 100 billion right away, or does it need 2 billion right away? It's not clear how fast they need to do it. So it may not be the case where you see everyone running for the door at the same time. It may be more gradual. And then what really kills me, dude, because we've been talking about this for years now, 2 years, and all these like James Belanco and all these guys. I was on a space call with these guys 2 weeks or a week ago, and on Mario's call, and it's like they're all making this doom and gloom about the Treasury issuance, and it's like, well, how come no one's talking about the $2+ trillion still in the reverse repo account? Like we've been talking about this ad nauseum for 2 years, and it's like that cash is still there. It's like all the Fed has to do is like it's paying 5.05. It's basically five. Yeah, it's paying 5 basis points above Fed funds. It's like that's ridiculous. That's perfect. You know, you could buy T-bills, but right now you got no risk, you got no market risk and no credit risk by sitting in the reverse repo. So it's like this nice little cocoon, and it's paying anyone that's in that, and it's not just the banks, of course. The Fed expanded the program to have a lot of near banks in it, so they're all sitting there and they're $2 trillion earning Fed funds plus 5 basis points. And so, are they necessarily going to want to go into T bills when that the again the rate on the T bills would have to cheapen up significantly above 5.05 for them to want to get into that, because they said they right now they're in a really nice security blanket courtesy of the Fed, and it's like, so what the Fed needs to do, if the Fed's going to play along with the Treasury here, when you think they would be, is they're going to have to do something to encourage people to leave reverse repo and actually buy assets. So that's where your liquidity would come from. So all these guys saying, "Oh, doom, doom, doom," yeah, it may be, but I think it's a simplistic argument, because again, there's the timing issue of how fast the Treasury needs that cash. But the other thing is, yeah, like this freaking $2 trillion in reverse repo that needs to to be honest, the only thing I could see why the Fed may not want to do that is because it's, again, when you park your cash at the reverse repo, the Fed gives you Treasury collateral, and then you've basically taken that Treasury collateral with no haircut. And you basically have taken out margin on that Treasury. So if they were to suddenly unwind those collateral, they lose their collateral as they buy T-bills, and then they would have to reestablish the collateral. But in the meantime, does that create a disruption effect? Are you so stressed out on your margin that if you were to even for like T+2, screw up your margining because you're buying and selling collateral, does that have an impact? I don't know. I'm just like, this is in the back of my mind, but no one's talking about it. So it's very interesting to me. It's like, we've been hearing about reverse repo ad nauseum for 2 years, and now no one's talking about it in the context of liquidity. It's like there's a huge. I've been saying for the last year that we won't probably see a bottom of the equity market until that reverse repo drops below 2 trillion. I mean, then we see that cash being deployed, then we know that the market's found a bottom, and that cash has not moved. It's still sitting there. So anyway, I'm very curious to see how that plays out with the Fed, and whether the Fed actually does reduce the rate on the reverse repo, and that will basically offset the liquidity problems caused by Treasury bill issuance. So we'll see.
So just to give you a number here, it said that the department's estimated would be to soar 550 billion at the end of June from Treasury bonds. Yeah. So they would probably sell quite a bit right away. And the thing is the reason I think that they would try and get the market is, foreign countries aren't buying bills at the rate that they used to. So I don't think they're as attracted to them as it used to be. So you're going to need more of your, citizens and funds to go ahead and buy those. Yeah. But go ahead. I'm sorry.
No, I'm just saying that's a very valid point. There's different reasons behind that, but a lot of it is the move to de-dollarize. China was the biggest holder of U.S. Treasury notes and bills, and they've been reducing scale. And it's mostly been, I don't know if they've been selling more notes and bills. Like, again, the term of what they're holding, what they're selling. But yeah, demand for Treasury bills falls in line with falling demand for Treasury notes in general. So yeah, they would have to make this juicy, and if there's less foreign demand for this stuff, and again, part of this is just natural ebb and flow, and part of it is this geopolitical push to get away from dollars. And so yeah, they're going to have to do something to attract alternate buyers, and whether that's other central banks like Japan, with Japan's got its own issues. So who else could buy it? Well, Saudi Arabia is again switching away from dollars. So you're going to have to, again, it's going to be it's not 500 billion in T-bills is not impossible. It's just all at once. It's a little awkward, but yeah, they're going to have basically, as you said, attract other sources of capital, whether that's from the current equity market investments or somewhere else. And I said the reverse repo is just an obvious one to me, but
Yeah, and that's the thing. Japan just launched their CBDC, and I feel like that's what they're trying to get to now is just get to that digital dollar, like you were saying. But everyone else is trying to get away from it, and I think Saudi Arabia was a lot bigger deal than people think going over to BRICS because that's oil money, and we used to have oil money on our side. Now it's against us.
yeah,
But
absolutely.
getting into that though, getting into what we are just going into with that, with the Treasury bills and trying to make it attractive, that leads into my next question here. So banks can't afford to raise rates. More programs are coming out, at 4%. Now the bonds are going to have to, raise the rates drastically to create demand. Do you see this, causing another banking crisis? Last week, $30 billion.
But it's not in the banking sector. So the other issue is all these bond investments that these banks have on their hold to maturity books. Um, the argument was, oh, the Fed is hiking, but now they're done and they're going to pivot, and they're going to pivot in 2023 fall. And of course, that's the few data points have basically not been supportive of a U.S. slowdown, which is interesting. But whether you trust the BLS data, Bureau of Labor Statistics, or whatever you want to believe in their data or not, it's basically reinforcing the Fed's talking points that they still are in a hiking bias. And yeah, the expectation is about a month ago, it was basically the Fed was done, and now it's like, oh, the Fed's got at least one, if not two, 25 basis point hikes left. So we could see Fed funds go to 5.5, and of course, Powell has always been saying, well, the terminal rate may be higher than you think. So the Fed, in their infinite wisdom, and I'm being sarcastic, but they have basically been keeping a hawkish bias, and that is prompting the yields on Treasury. Like 10-year Treasury was around 340, 338 2 weeks ago, and it got up to 380 yesterday, or it was Friday afternoon. Okay, and then on the long weekend, the market's closed, but so it's 10-year Treasury's off down a bit, 8 basis points today. So it's a little moderation, but the fact is it spiked up about 50 basis points from a month ago. So that just is showing you that, like they're pricing in more rate hikes. And what does that do for the banks? Well, again, they've got all these hold to maturity losses on their balance sheet with these bonds. They can't sell them. If they want liquidity, they can't sell these things because they'll take a huge capital loss. And that is exactly what happened to Silicon Valley Bank. Now, Silicon Valley Bank didn't take a hit on their hold mature. They had their marketable bonds, which was ones they said, yeah, we can buy and sell these things. So, the fact of the matter is that all the banks have huge hold to maturity losses, and that's why the FDIC and the Treasury created that sort of pawn shop for the banks to park their hold to maturity. Give us your bonds and we'll give you cash 100%. So we'll basically eat the capital losses temporarily. Let's see if those bonds ever get bought back by the banks. Yeah, so like this is a 1-year repo facility, and we'll see what happens in 10 months, and whether the banks have to make good on buying those bonds back at their at the losses they took. That's my cynical thing, is wondering just how institutionalized the banking losses for these bonds will be, whether they'll just pass it on to the taxpayer via that structure. Oh no, it's just temporary. Yeah, like taxes are always temporary. So anyway, all that to say that higher rates are being priced in. That's not good for financial players who still have too much leverage. Yeah, and definitely if the Fed jacks up the Treasury bill market to get the Treasury to be able to sell those T-bills, and then if they hike rates on the Fed funds rate because they still think inflation is a problem, and inflation is still well above their sort of guided target of 3%. So The chances of the Fed hiking again are quite real, and I don't think they're cutting this year. So there's no relief for anyone that's sort of hoping for like some reversal of their capital losses. And the only thing again saving them is that at least the banks, they have this dubious accounting mechanism where they don't have to realize those mark to market losses as an off balance sheet loss. It's BS, but that's their idea of financial stability, right? So um, yeah, I don't know what will break the camel's back, but I suspect we're not that far away from, like, the Fed can't hike willy nilly. And the problem is that inflation's not, inflation was, there was disinflation, which means the rate of inflation was decreasing as opposed to increasing, but that stopped. Same in Canada, same issue. The Bank of Canada is expected to now looking to hike at least once more this year, maybe twice. Um, and the really strange thing in Canada's case, in Canada's case, we're seeing extreme home demand. Like, housing sales are very strong, despite the interest rates being 4.5% higher than they were last year. Um, and Yeah, job creation strong. I look at the numbers, and immigration only explains a little bit of it. And of course, in the U.S., like, people, whether you're pro wall or whatever you're about immigration, the fact is that immigration in the U.S. has been a huge supporter of the housing market and by extension the U.S. economy. So all those illegal immigrants eventually do find places to live, and they're paying rent under the table. However they're doing it, they're feeding landlords who basically build new apartment blocks, which creates new jobs. So yeah, the immigration has been one thing that's been a big support for the U.S. economy. So I don't know. I'm not following these immigration laws, and I'm not an expert on what's going on the border, but it does seem to me that could have an impact in terms of the housing demand. And if you already have, again, high interest rates, and you've got mortgage resets in terms of commercial loans coming due, yeah, it could be very messy. And hiking rates in that environment is just going to add to the pain. So.
I mean, that leads right into my next question. Actually, I've had this up on the thing here. So I've been telling you that there's going to be a housing crash in the United States, and the current median price fell from 480K in Q4 2022 to 437 in Q1. So that's a 9% decline. That's massive, massive decline here, and rates are going up. The average right now is 7.14, and feds are going to have to keep hiking it. You see the housing market continuously decline, and since that's the Fed's biggest asset, what effect do you think that has on the Feds as well?
Oh yeah, no, I mean, uh, as I said, it's really unclear how much of the, like, where's the demand for housing coming from when rates are high and getting higher. And the one thing with the U.S., and you guys got to appreciate what a special situation you're in. You guys are able to take out 30-year mortgages, and your interest payments on that mortgage are tax deductible. So you have a lot of incentives to buy houses. You can, yeah, a lot of smart people in the U.S. probably either bought a new house in the last few years and locked in a very low rate for 30 years, or they they renegotiated their existing mortgage at a low rate. And whatever they, typically what happens is U.S. households then take those equity, like the gains from saving on mortgage costs, and then they take out a new equity loan or whatever they do, so that facilitates consumption. But that money printing machine is now done because rates have been higher for a year. So everyone that's refinanced their mortgages has likely already optimized things. So there's not going to be a huge amount of, like, consumer demand arising from, hey, I've lowered my mortgage payments. Everyone's taking advantage of that. The party's over, and the rates keep going higher. So you don't have the problem where we do in Canada, where if you have a 30-year mortgage, you got to renegotiate it every 5 years, or it depends if you have floating or fixed. But if you take a 5 year, you can't get a 30-year fix. You get a 5-year fix, and then you got to renegotiate it every 5 years, or you can take a 3-year fix, whatever you want to do. Like, I took a 3-year fix last year because I figured, well, the bank is going to have to cut within 2 or 3 years. So, but the fact is that Canadians have a huge rollover risk, and a lot of people that bought a house, God forbid they bought a house on floating, and they've been just being dinged every time the bank hiked last year. But a lot of people probably took out a 2 or 3 year fixed last year or 2 years ago, and they're going to face reset risk. And so in Canada's case, I'm expecting some sort of slowdown. But in the meantime, we're seeing crazy housing sales, and housing prices haven't fallen. So again, it's the same situation in the U.S. even more so. It's like the you can see the disaster on the horizon, and yet housing market has been relatively stable in the U.S. So what's going to cause it to break? And I think, yeah, at some point you're going to have somebody that's got exposure to higher rates, and they're going to have to renegotiate. And the degree to which the Fed is hiked and the pace of it is historically very unusual. So a lot of people are going to face pain, and people, of course, point to the commercial real estate sector being the most vulnerable, and I think that's correct analysis. It was already vulnerable, going into COVID. The trend for electronic shopping online was killing the major malls and strip malls. It's like, so like I can order my shoes from Amazon. Why the hell do I need to go to Foot Locker? Uh, and that trend hasn't changed. And then in addition to that, then you had COVID, which killed a lot of people's like tenants. Like, I can't get any foot traffic here. I'm just going to close up. So a lot of these, commercial real estate developers are sitting on these, properties that are half empty or maybe three quarters empty. And, they again, probably were smart and locked in the very low financing rates, but they cannot get 30-year mortgages. They have to take short-term financing, and they're going to get screwed in whether it's the end of this year or before the end of this year or maybe next year. But they don't have the revenue to support higher interest rates on their properties. So there's going to be and we're seeing these. You just scroll through your Twitter feed. Like, I get like, oh, San Francisco office space. It's like, the value of the property is basically negative because the obligations are more valuable. Sorry, the price of the obligations, the loan obligations, is higher than the actual value of the property, and you're seeing that in New York too. And the constant stories about how working from home is killing landlords in New York, and like, but yeah, like the San Francisco one is the obvious one because everyone keeps showing pictures of closed up stores and empty streets and poo on the streets, and it's like, it's like San Francisco is like something out of a bad movie. It's like Escape from San Francisco, right? So yeah, I think commercial real estate is going to be a major problem soon, and I think that's going to be really what causes the next calamity. And we talked about this before. It's the commercial real estate loans are primarily held with the regional banks. So, the regional banks have been on life support, and I think this may take some of them off life support and put them into the morgue. So it's going to be very, very scary. And yeah, if the Fed wants to keep hiking in that environment, yeah, more fun. Yeah, let's do it. So again, why is the Fed doing this? The Fed is doing this because they botched. Well, they've botched.
Everything.
Go ahead. I'm going to go on a rant if I start. So go ahead with your next question.
No, you're fine. I mean, you basically were leading into it too. So, New York City freezes deposits at Capital One and key banks. This is another thing I've been warning people to get away from banks from because they can freeze their assets when this crisis starts. This is another reason why I feel like it's more attractive for people, and why they will also be getting away from banks and going towards treasury bonds. You've seen freezes in the future of the United States.
Yeah. Yeah, just there was that one story about New York City freezing deposits. That was only regarding their deposits with those banks. Basically, they were told to do something about racial discrimination policies, and they did not. Those two banks did not follow through. So New York said, "Yeah, we're not going to be doing any business with you anymore." So but in general, yeah, like the risk is of like anything, and I think I mentioned with regards to AMC and GME, it's like the risk of government intervention is higher than it has been, because the system is so effed. So, but what that looks like, and how does that look like? Do they freeze your deposits? Like, we all know that it's hard to take out cash above 10,000. You go to a bank and say, "Hey, I need 20,000 US out of my account." It's like, why do you need this? Yeah, who is extorting you, sir? Like, are you safe? They'll come. We can't give you this money because of any money laundering laws. You need to wait a week, or we need 10 pieces of ID. It's like they'll come up with all kinds of things because they're trying to limit your usage of large amounts of cash, and this is an example of government like oversight and override, and to some extent, to combat money laundering and the underground economy and to make sure taxes are collected. That's part of it. But like again, you could go into the conspiracy mode and say, well, this is just the front wedge of the government like controlling your life. And I mean, we're going to go into digital currency discussion if I go that way. But like that's the thing. It's like, are we being set up for government control via a digital currency? And the stuff they're putting in place would be sort of a sort of the God, what am I trying to say? The building blocks for that. There's an engineering word I was looking for, but I'm mentally blank right now. But yeah, I do think you know I never was against you saying go to credit unions. The only issue I have is like uh, it's just sometimes credit unions aren't quite as like in Canada. They are more or less the same as banks, but it's sometimes you run into like, are they on the same like payment system and all kinds of, it's sometimes it's a little more cumbersome, but overall, I mean, that in regards, if you think the system's going to go down, then maybe you want to be away from the other system payment platforms. So I don't know. I think I think there will be a real challenge to the banking system in the U.S. I don't know about Canada's case, and I don't have enough information on Europe to know how badly they're off, but I suspect that there's a lot of strains in Europe as well. And the UBS Credit Suisse thing just illustrated that, right? It's like that. I'm still kind of like mind boggled. I called it. We both called it, but I said, look, UBS is going to be forced to buy Credit Suisse, and whether the Swiss National Bank was reading my tweets or not, but that's exactly what happened. But like, look at the terms. It's like, yeah, like we won't do this unless we get a $6 billion guarantee. Okay, we'll give you a guarantee. No, well, actually, we took $17 billion in losses doing this because you rushed us to do this in like a weekend. So if that was the hidden landmine that Credit Suisse have, what are the other European banks? What's Deutsche Bank? What the hell? What kind of grossness is there? So, yeah, like
Speaking of them, real quick, not to cut you off, I just got to bring this up. Did you see they paid $75 million fine for facilitating and profiting on Jeffrey Epstein's island? They were a part of it, and all they had to do was pay a $75 million fine and not admit guilt.
yeah. I saw that. It's disgusting. And of course, that's J.P. Morgan and Deutsche Bank were the two banks for Epstein. So, Jamie Dimon. I know how I feel about Jamie, and I'm not a fan of him either. But yeah, he's excuse me. One way or the other, J.P. Morgan's going to have to pay some money out of this. Like where the Virgin Islands gets everything they want. I mean, it's kind of interesting, and they didn't settle out of court already. I suspect that, like, you can't tell me that Deutsche Bank will pay 75 million, and J.P. Morgan expects to walk away from this scot free. No. He's just playing for time. I think and it's just like I can't stand Jamie Dimon, but like I got to give him credit. He's okay. Trump gets a lot of Teflon things. Trump does ridiculous things and nothing sticks. Well, maybe thinking will stick now, but like Jamie Dimon's the same thing. It's like J.P. Morgan has violated so many laws and like how many times can get fined, and yet Jamie Dimon's still a CEO.
236, 236.
Yeah, I mean it's just insane. It's like the Teflon bank, and J.P. Morgan, like we have a rule 10% deposit limit for total. Oh, J.P. Morgan, no, we'll make an exception. You can have 19%. Like what the it's like it's crazy. And
That's because they have 4,832 clients that are hedge funds. So if JP Morgan goes down, everything does, and they can't let it happen.
Yeah, and there's that. And that's I no offense to you or anyone else that posts this stuff on Twitter. Sometimes I can't read it because it gets me sick. Like I worked in the banking industry. I know like the ones I worked with have had issues. Not I never saw anything directly where I worked, and I said, yeah, well, okay, let's be fair. When I was trading FX, I saw FX manipulation at the London Fix every day, and I traded off it. But it was like it was obvious. Like I knew that the price was going to do this every day because someone was manipulating it. And prior to the LIBOR 2014 thing and the FX rigging thing that happened around the same time, I would actually have sales guys at other banks saying, "Hey, we're seeing." Like it's extraordinary, but I'm saying, yeah, we're seeing a French Canadian pension fund that needs to buy 100 million at the noon rate. It's like, okay, well, you're telling me this. How many other people you told? So it's like the rate. Obviously, the rate is going to go higher because everyone knows about it. So there was that kind of crap going on all the time, and then they tightened it up so like chat functions on Bloomberg and all those things got monitored. But then they started going to WhatsApp phones, and that's why you're seeing a lot of these banks getting fined now for undisclosed conversation, or bank not doing enough to monitor undisclosed conversations on electronic media. In fact, when I was at Scotia, apparently Scotia got fined for this very offense. And when I was at Scotia a few years ago, I got this weird email saying, "Hey, if you have WhatsApp or whatever, get off, dismantle it from your immediately." And it's like, this will be enforced strictly. It's like, oh, okay. Well, I don't use it anyway, but interesting. And now I know why. It's like, yeah, there were traders in New York that were using, off, even on their personal phones, using like chat functions to negotiate like collusion, right? So, yeah. Where I'm going with this is, yeah, J.P. Morgan is the ultimate bad guy, and yet because they are too big to fail, they're allowed to like I said, the gold market stuff drives me crazy. They were fined 930 million, and their trader was found guilty of basically violating RICO laws, and yet J.P. Morgan is still allowed to be the number one gold silver trader. It's like,
It was 12 years, wasn't it
yeah,
like 10 or 12
yeah,
years?
yeah,
12 years, and they have a short position larger in gold and larger than their assets, which is they're already over leveraged in that. They have the most derivatives contracts out of every three banks, totaling 53 trillion.
yeah.
That's why they can't let them go down, because the entire United States will go down. And I've been saying this forever. Like you said, I hate Ken Griffin, but Ken Griffin's not even close to Jamie.
No,
Jamie is the biggest piece of shit on the
yeah,
planet. I don't care what anyone
yeah,
says. He really is. It's just disgusting.
yeah.
But
Let me put
now
it
that
this
we're
way:
talking into
Ken,
that,
Ken
yeah,
Griffin
go ahead.
Ken Griffin is Sauron, and Jamie Dimon is Sauron. So like, yeah,
Yeah, exactly. I just get mad talking about Jamie Dimon. I hate him. He's just a piece of shit. But getting into that percentage before we go back into the economy, since we're kind of on that kind of topic, I want to get your thoughts on this real quick. So, more and more stuff's been coming out about Elon Musk and Ron DeSantis, and he signs a bill which shielded Elon's company from any kind of lawsuits that were going on. And on top of that, you saw Ken Griffin and him at the soccer game in the skybox. Ken Griffin also went ahead and gave Elon money to buy Twitter. On top of that, Elon hired somebody from the West to be the CEO of Twitter. Everybody used to think Elon was, this guy good for people, but now you're seeing he says this, but all of his actions say that. What are your thoughts on Elon and what's going on with Ron?
yeah. And it's funny because like everyone, Elon, he presents a likable facade. I mean, he's like a boy genius. Well, he's no longer a boy anymore, but it's like let's be honest. This guy has been involved in multiple sexual harassment claims. Like, and it's like, here, I'll pay this chick $250,000. Go away. So he's not like a Boy Scout. I remember he got involved. Like there was this cave flooding in Thailand, and he wanted to be a hero and go down there. And then one of the guys running the rescue said, "Go away, we don't want you." And then he accused the guy of being a pedophile or something like that. It was really strange. It's like Elon has displayed some very abnormal behavior, and so it would be misguided to like. I look at him like Howard Hughes in a way. It's like if he's creating positive growth for society as a whole by innovation and all that, then that's not too bad. But like on a personal level, he's an abhorrent human being. And I get Howard Hughes the same thing. It's like Howard Hughes was a terrible person, but he provided a lot of benefit to the U.S. growing at a time, and so it's Howard Hughes is a big reason why the film industries exist. So it's hard to like get too like it's not gray and not black and white. It's very gray with Elon. I do, however, think that absolutely he's dealing with Ken Griffin and he's dealing with Ron DeSantis, and like I said, Twitter basically he's basically not paid the rent on Twitter. I don't know if he's resolved that lawsuit yet or not, but I suspect it's like San Francisco wouldn't have been his choice if he had built Twitter. And so I speculate that he would probably move the headquarters sooner rather than later. And whether it goes to Texas where everything or you go to Florida to appease Iran. I mean, like I don't know. It's like, yeah, but I see Twitter moving, and so like this whole relationship with Ron DeSantis is very interesting. As you said, it's clear he's taking advantage of the fact is SpaceX facilities could I don't, again, I'm not clear on where SpaceX is. It's mostly in Calgary. Mostly in Calgary, mostly in Texas, or mostly in Florida. I don't know what they have in Florida, but it would make sense that he want to piggyback off Cape Canaveral and everything else in Florida, and perhaps build a more bigger presence there. And so he wants to have an alliance with DeSantis, and yeah, like having no liability for anything that happens in Florida would be a huge benefit. So like he's going to suck up to DeSantis, and hence we have the infamous Twitter launch. And I listened to that ridiculous call. I was one of the people that stayed on for both the short abbreviated prep that nothing happened, and then the actual call. Whether it was a PR disaster for DeSantis, God, my brain's. I didn't sleep much last night for various reasons, but anyway, I'm getting word salad, so just bear with me. But I do think that whole Twitter launch was basically Elon, helping DeSantis get some visibility, and like if you listen to that call, it was unscripted. Elon says, "Oh, bullshit." Excuse the language, but it was completely scripted. All the speakers were prearranged. I'm sure of it, and all the softball questions were prearranged. And it was actually kind of embarrassing to listen to. It's like half the speakers before they started talking about Tehran, they go, "Oh, Elon, you're such a genius, thank you for hosting this." And it's like, oh my god, okay. I mean, so yeah. I do believe that Elon is not innocent, and
Ken Griffin saying donor, I'm ready to back him for president in 24, and now he's going to run with him. And like I said, it's just a big hand job club is what I like to call it back there. It's just ridiculous. But let's get back into the economy and stuff here. So I want to talk about that short seller law there. So one of the reasons I really believe that they're talking about, U.S. short seller things, they're going to come up with the banking short selling restrictions is because, you're going to see all that another crisis coming from these treasury bonds. And I believe that was 100% to stop them from also, crushing as many banks as they can in the process, because there's already going to be so much that they can't handle. ISDA just came out last week and talked about the credit crisis. And Gary Gensler was also talking about how there's basically zero margin now in lending for these funds because of, there's no credit, there's, no liquidity going around. And now phase 6 is coming in June, so it's going to be even less. And there's going to be, even less credit available. What do you think is going to happen in the next couple months here with the short selling on banks and with these contracts being renewed?
Yeah, I mean, and yeah, we know that we have basically three plus months before ISDA phase 6 really hits. So the writing's on the wall, and what I think, again, my supposition is that the Fed, SEC, they're all aware that this market has been shorted to death, and basically by extension, the amount of leverage employed was over the top. I mean, I don't do fact checking on people like Thomas Janes or New York Angela when they talk about Citadel having 50 times leverage in some cases, but yeah, they're certainly employing higher leverage than probably is prudent, and so everyone's overextended because they got to maintain all these shorts. And what does this mean? Well, then the banking sector issue came up. There was this video going around December last year where it was like this closed door FDIC meeting where saying, should we tell them that the banking system's screwed? No, they'll find out. And so what happened in late February was the FDIC put a report saying, like, here are the mark-to-market losses on the hold-to-maturity bonds, and that sort of floated under the radar for a week until SVB blew up, and they took a hit on their marketable bonds portfolio, which they have to mark to market, and then they tried to do an equity raise and they couldn't do it, and that's when the pillaging started. But that's when people noticed, the FDIC put out, it's just not Silicon, because you get the cohodes types that go, I just killed on Signature Bank, or I just killed whatever Silvergate, I'm going to go look for my next target. And then lo and behold, this FDIC report sitting there showing all these banks are vulnerable. It's like, happy day for shorts. It's like they just made a killing on one bank. Now they can go kill 10 banks. So that's what happens. I'm okay, I'm going to keep my emotions out of it. But like they basically go crazy and they see like look at all the money we can make by shorting this, and not just one bank. We can short 5 banks, and like we can use our usual bullshit tactics of coming up with fake stories and oh like this is Pac West, but well we'll sell the other Pac West too because the name's similar and they won't know that So they're doing all this the same stuff they do with AMC they've been doing with the banks, and as a result you get like multiple banks being targeted and you get these ridiculous moves in pre-market and post-market where no one's really trading except from the institutional players, and they're creating these panic moves. It's like, oh, PacWest is down 50% in the overnight. Oh, when market opens, I better get out. So that's, I think, what got the attention of like the White House, and finally, Gary Gensler got a call saying, "Hey, stop dicking around and do something," because you've got predatory shorts going on, not just in AMC and other meme stocks. Now you've got it on regional banks, which have a lot of issues already. The problem is that JP Morgan can only take on one or two buys at a time, and like you're going to have to see a wholesale. Whatever happens, you're going to see mergers in the regional bank sector. It's clear that they're losing deposits too fast that they're going to have to basically grow together. You're going to have buyouts. Just there's too many regional banks, and they're not going to be able to be profitable if they keep losing deposits. But then on top of all that, then you have these predatory short sellers trying to take them out. And when the FDIC comes out and says, "Oh, First Republic, oh God, JP Morgan, we need you to buy them, but here we'll give you this really sweetheart deal, and we'll take off like $10 billion of the liability, and we'll absorb that." So instead of the FDIC having to pay 20, 30 billion to take care of Federated Republic, they only have to pay 10 billion. Okay, JP Morgan takes all the other assets and cherry picks what they want. And so, okay, prices mostly resolved. JP Morgan is now 20% of US deposits. Yay. Okay. But you can't do that every time, right? There's only a certain amount of banks that you can keep doing that with, because there's not going to be enough banks that are healthy enough to buy the unhealthy banks. And then the other issue is the FDIC has like a fund that was basic. Oh yeah, if we need more funds, we can get the Treasury to write us a check. Well, the Treasury can't do that when there's a debt ceiling. So there's a very vulnerable period here, and I guess we're still in it until the House votes yes. So in the meantime, FDIC, they have about 80 billion. No, that's more than enough. Don't worry. But if you had 3 or 4 Federated Republics, and Federated was a big bank, so it's not like, but if you had 10 or 20 smaller banks at the same time, you could easily eat up that 80 billion. And then what happens? So then you have no ability to rescue any more banks. And so I think what happens was the short sellers were doing their crap, and they're attacking multiple banks at the same time. And the degree to which the share prices were dropping so quickly scared people in Washington to realize, hey, this is an attack on the financial system. And it was. It's not like Mark Cahodes is out to go destroy the financial system, but he is sensing an opportunity. And so he's going to go short every bank he can find, and he's going to use his usual bag of tricks. And it may not be him. I'm just using him because I know he shorted Silvergate. So anyway, the fact is that these guys are taking advantage of an arbitrage opportunity, but it's not good for the, everyone that says, oh, hedge funds are a benefit to the economic system. Sometimes, not all the time. Sometimes they are accelerating, just exactly like, okay, Credit Suisse needed to die, but did it have to die the way it did? Maybe not. It wasn't the most optimal. So that's what I'm saying. The U.S. authorities are looking at this saying, we don't want to have to do what UBS, we don't want to force a UBS Credit Suisse thing. So we need to stop this crap because it's already taken out 3 major banks. And so they start making noises. Oh, Gary Gensler, yeah, we can take authority to, it's like, oh, Gary, you're making noises. Are you actually going to do anything? Well, this time maybe, because it's the banking sector. It's not AMC. So I do think that's why all this sudden talk about regulating and, short selling banks. And we know short selling ban on banks in 2008 didn't really matter much because the panic was already in. So it may not matter again if they do a short selling ban, but the DOJ has basically made noises. Oh yeah, we're still investigating short selling, and now we're going to be coming out with some results in a few months. So yeah, they've been sitting on this since January 2022. So 18 months now. But we're going to finally get around to actually charging someone. Okay, you've been sitting on this information for months. Yeah, I know they were reading my LinkedIn post for most of 2021 and 2022. So don't tell me they don't know what's going on. So I'm sure the DOJ will do something, and that will be interesting timing. Though a few months would be right before the phase 6 hits. So I think this is all being set up to punish someone, basically, because the shit is going to hit the fan in some fashion in the next few months. So a long diatribe, but yeah, the shorts basically pushed their luck and they went too far, and that's my view. Is they prompted the regulators to finally get off their ass.
No, I agree with all that. And like I said, and that's about the time I've been saying forever now for phase six. It's said this credit, it's there's nothing left. They cannot sit there. And right away, they used to be able to just use a credit support annex, not put down any collateral, just a small percentage of a fee. And now it's like now they have to put down money that they obviously don't have because everyone is over leveraged. It's just ridiculous. We're basically going back to 2008 again. I don't know if you saw that they're back to ninja loans, but they're going back to 1%. They're taking 1% mortgage down payments now again.
Yeah.
Yeah, so it's like basically history is just repeating itself. But one of this next thing I want to talk about, I don't know if me and you've talked about this yet at all, actually. But so the new proposal from the SEC with the auction house, you can see, market makers are just fighting it tooth and nail. The other day, Citadel, they started to brag about, oh man, we add 15 billion a year into the market, into the financial system. When it's like, okay, so basically you're admitting to people you sell $15 billion a year in stock of synthetic shares. But everybody says synthetics, but I always call them not synthetics, market maker exemptions. It's Rule 203B. I can fill your share before I locate my own.
Yep.
So basically, this will get rid of that exemption for those market makers because they'll have to go into the auction house. On top of it, it gets rid of payment for order flow. What are your thoughts on this new proposal, what it does to Citadel, and will it actually, like I believe, will actually kill Citadel and Virtue?
Yeah, it's one of those things where it's like it's been talked about for so much and so long that I sort of have not signed off on it, but it's like, yeah, like, okay, Gary, this has to be done. Get on with it. And I do think like they're fighting tooth and nail to stop it, which tells me that like it's not a case where anything they're against that I'm for, but it really does come down like yeah, what you guys are like. I posted a few weeks ago. I don't remember long ago, but I said, Citadel, the problem with you guys is you've got such a ridiculously bad track record in terms of FINRA fines that like I'm suspicious of anything you put out. And there's a lot of people like me that don't believe anything you say. So even if you were being the perfect Boy Scout, which we we know you're not, um, anything you say is self-serving. And so I'm sitting here waiting for the SEC basically to see if the SEC is captive to these interests or whether they actually do what they know they have to do. Um, and yeah, like again, the business model that these guys have been using, for someone that was against payment for order flow 10 years ago, and now it's basically reliant on it for their business because they realize, oh my God, when we control the flow, we can do whatever the hell we want with this market. We can, what they've been able to do in the option market is astonishing to me, but like it's all about control. If they have this much control over order flow and then they have control of a dark pool and they have the ability to time order execution. It's like you are a fool to be executing option trades in any kind of market where they can dominate spot. And so it's not so in a market like Nvidia or Microsoft where there's huge amounts of flow from institutional players, then that's not going to be an issue. But in a retail stock like AMC, it's like I was trading options quite a lot for the last 2 years. I gave up. It's because the last few months have been appalling, right? The volatility has been sucked out of the market. You look at there's no trading going on. The retail is basically buying and holding, which is fine, but it's you look at the volumes and it's like, yeah, this is just wash trading by algos. Like there's no, this is these 10 cent, 20 cent drops every day are BS. Like if someone said, oh, AMC has been like down 14 out of 19 days since earnings came out, it's like, yeah, it has nothing to do with fundamentals. Like we know fundamentals will eventually move this thing higher, but AMC's not going bankrupt. But in the meantime, because of Citadel's Virtue's control over order flow and everything else, they can basically the algorithm has absolute control over the price. So I don't even look at the price anymore. Like it's kind of sad. I mean, I'm sure it'll pop one day and I'll not even catch it because I'm basically looking at other stuff. It's just been so discouraging. But that's the thing. These guys have to have this system in order to keep control. If they lose control, if pricing is more transparent or not captive to their interests, uh, Yeah, it's going to be awful for them, and they'll have to again evolve. And Ken Griffin is a cockroach, and he's evolved, but he's survived many times before, and he'll survive again. And he knows how to play the system. And like again, Thomas Jane, oh, I love his clickbait, but he did, he read back to 2021, the House Senate committee. How many people on that committee had received financing from Ken Griffin? Quite a few. So it's like this guy will find a way to survive. But in the meantime, I do think with all the shit that's gone on, and this market is about to have some very nasty outcomes likely. Yeah, he's going to basically be hard pressed to justify keeping the status quo. So I'm hoping that the SEC actually gets on with it. But like anything in Washington, this will take years. So
Yeah, that's true. That's true. Yeah, a person just pointed out Goldman Sachs. They expect the Treasury to quickly raise $1 trillion if it's approved. So this is what I'm saying. I really believe that there's going to be a market crash here pretty soon in June. And also you got LIBOR switching over. You got the Phase 6 contract. So I feel like June's going to be a pretty interesting and telling month on what's going to happen going forward here.
yeah, and then the LIBOR thing. Um, Now, like that is an interesting point. Like you wanted to talk about LIBOR the last call. I didn't really have much to say, but there was an interesting Wall Street on Parade, which is a private site. They put out a story on there's a book out there that accuses the central banks of rigging the LIBOR market. Now it's interesting because in 2014 many of the major banks were fined for rigging the LIBOR market. So I was thinking, well, the rigging was going both ways. It was like they made the rates higher when they wanted them higher, they went them lower when they wanted them lower. But okay, so one of the benefits of having been in the banking industry and I worked with central banks, so I actually have a connection who was at the IMF, and he basically he related to me the other day, a few days ago, that he was at the IMF and he did a study on this and basically found that the central banks were basically aware of the rigging, and as long as it was rigged lower because financial stability needed lower rates, they were happy to look the other way. So it's kind of like it's disgusting. And I had to make a post on LinkedIn saying, look, I was at the Bank of Canada up to 2006. I wasn't aware of any of this going on. But that being said, the Fed and other banks quite possibly they would have had these conversations where they said, yeah, like we know that you're rigging the rates. We'd appreciate if you bias it towards the low side as much as possible because for financial stability reasons, we don't want to have to do extreme measures. And like, yeah, this book apparently directly implicated the Bank of England and as basically saying to banks, yes, we want you to lower the rates. So it's disturbing. So of course, after 2007, 2008, this was never heard of again. But then in 2014, all the banks got fined. It's like, aha, yeah, you were rigging because we asked you to in 2008, but we're fining you for stuff you did beforehand and after that. So it's like it's ridiculous. So, and of course, what are they going to do? They're going to say, okay, we'll pay the fine. So, but it is really interesting. This LIBOR has been compromised. And again, I said I didn't trade LIBOR, but a lot of well, all the major swap indices are based on LIBOR. Or they were based on LIBOR. So all these trillions of dollars of contracts were based on LIBOR. And because of what happened in 2014, and because basically LIBOR was like a gentleman's agreement, and it wasn't based on actual trading. You could have no liquidity going through, and that was a point the guy at the IMF told me. Is like there was no trading going through on these. They were just basically making up numbers, and there was no actual trades. So it's like it's basically like saying AMC is trading at $2. Oh, how much volume trades there? Oh, one share. It's like, are you kidding me? So that's what basically was going on with LIBOR. So it had to go, and so they basically had to come up with something that was better. So SOFR, which I can never say the words behind the acronym, but basically it's based on the overnight repo market. So the swap financing rate will now be based on actual trading in the repo market and the overnight repo.
It's secured overnight
Yeah,
financing, right?
thank you. Secured overnight financing rate. I don't know why I have a problem with that, but yeah. So the secured overnight financing rate is based on overnight repo. Uh, again, repo market has been problematic, but now the Fed has got a presence in the repo market and is there to ensure liquidity. So you could also say that SOFR is liable to manipulation as well if the Fed comes in and starts throwing around huge amounts of repo funding, which they have done. So It's not like,
That's why I think they're going to move to the bonds and out of the repo because of the LIBOR switch. Sorry.
yeah, exactly. So this is going to be a mess. I mean, most of the switching has been done, my understanding, but there's a lot of grandfather swaps that are still probably on LIBOR. So yeah, it'll be messy, and it's all coming to a head in the next few months. So
It was like 70 or 80 trillion still left over. It was a massive number.
yeah, no, exactly. I mean, I haven't been on top of it just because it's like, I know it's a problem. I just, when you get to big numbers, that's like 80 trillion, 90 trillion, whatever, it's kind of sad, but that's like, yeah. So I know it's like, I've been surprised how relatively smooth the transition to SOFR has been. But again, once you get to the actual end completion date, I'm sure there's like all the hard parts are left, right? All the easy transitions are done, and then it comes to the awkward swaps that are kind of wonky, and then those will be the problem ones that'll maybe screw up the system.
Yes, I saw a report the other day also. I don't know if you saw this, but hedge funds are exploiting the way to make money on the debt crisis is they're actually using government bonds. And now the government's actually, going after them. But one of the main people that was mentioned in the article is actually Citadel has been doing it under the Millennium Management Group.
Yeah. Oh, yeah. So this is they got caught in 2020 on the wrong side of the trade, and so they needed the government to basically come in and do what they did for cutting rates to near zero, and there were dislocations in the government bond market, and the arbitrage that should have worked didn't work. So they need the government to come in and it's like what happens in the gold market where you have you got the futures in the spot and the dislocation. It started to unravel because, like, I'm sorry, I'm going to a little tangent here, but what happens when you deliver gold for a contract, the contract specifies what type of bar it is, what the purity of the gold is, and all that. And so they ran out of the right gold bars, so they had to actually go melt some gold and reforge it into the right bars, and that was a time dislocation issue. And so meanwhile, the gold market, the futures and spot market got wonked up because of that. And that's sort of what happened in the bond market. There wasn't the right futures contracts on bonds are based on what's called the on the run bond, which is basically the most liquid bond that's currently trading. And sometimes that may not be available. Like there may be shortages of that bond, or there may be other issues going on with that bond. And so you get like the futures contract is based on a bond that's mispriced. And that's what I think happened in 2020. And that's probably, they're saying that these markets are, with the debt ceiling crisis and the curve inversion and everything else that was going on, like the CDS, all the derivative markets based on short-term interest rates are all effed up. So I think that's what was saying is like, yeah, these firms may have taken these leverage to too high to extent as they tend to do, and again the mispricing and the bond is creating a problem. If they need the Feds to sort out the market, so there's gonna be more of that, and it's just these guys need to stop freaking. They shouldn't have so much leverage, I guess is what I'm coming to. This is why I think we'll go back to what you were saying about the SEC, and there needs to be like this has to be tamped down, and so the SEC has basically said now you can do margin. Is it the SEC or DTCC? I can't remember. You can do daily margin calls now for brokers. They can do margin calls as
the clearinghouses.
Yeah,
the clearinghouses can do the daily margins. But I mean that's the thing that gets into my next question. At this point, it's like I feel like every single thing they have is tapped out. They've moved everything to everything. I mean, at some point, something's got to give here. I mean, every program they've made to back up another program is exhausted. The FDIC's already has to raise extra $16 billion from the banks. Like you said, they're not going to be able to afford another crash. 3 banks crashed, and talking about over leverage as you went into. 3 banks crashed, and those 3 banks had the total amount of assets of all the banks in 2008. Just 3.
Yep.
And like you said, if 10 more happen, what happens? Now you have a thing like I've been saying, it's 2008 on crack. You have suddenly 7-8 times the amount that crashed in 2008. Yeah. That's a huge deal. And it's like, at some point, something's got to give. Everybody keeps thinking they can drag this on forever, but I mean, other countries are even seeing it. They're seeing that, that's why BRICS is gaining more momentum. The dollars, everyone's trying to get away from it. It's a financial bomb. Do you
Yeah.
see any way for the feds to rescue this current situation, or do you agree with me that the only way that they can get out of this is to prolong until they can get to CBDCs?
Yeah, I know. I would tend to agree. So like all this noise is a big cleanup job, and the only way to do it is by printing money. But if you print money, you're just going to prolong inflation, and puts to bed any sign that the Fed is actually serious about fighting inflation, because they can't. They're trapped, and I've been saying this for 3 years. There's too much debt. There's absolutely no way around it. You need to print, and you're going to have inflation. Well, we don't want inflation because we'll get voted out. Well, okay. So how do you disguise this inflation? Well, you sometimes you change your currency. You do some sort of, like, we're going to issue a new currency. Okay, well, digital currency is a new currency. So I think it's inevitable that, like, to hide the fact that they're going to have to print money to fix all this crap, and it's inflationary. And the only way to hide that inflation, even for a short period of time, is through digital currency. And it's like, oh, this dollar is not the same as you. Oh, it's no, of course not the same. It's like, that's, it's like life is different. But yeah, they'll hide it. They'll disguise the pain as much as they can. But yeah, the fact is that um, I don't know. Again, I've said this before on these calls, but I grew up in the '80s, and Michael J. Fox is Alice Keaton on Family Ties. Like, yeah, this is my guy. Like, I'm a total yuppie. I agree with, like, right wing Ronnie Power. Ronald Reagan is away. And as I get older, it's like, there's a lot of short sighted. The problem is, like, you get guys like Ken Griffin that exploit things to extreme, and too many people are taking advantage of the system's uh, inefficiencies and making themselves rich at the benefit of society. And so ultimately, a lot of the problems that we've had are like a wealth accumulation on, like, a small few, and meanwhile the rest of the people suffer. And like, the system is flawed, and the system needs to get fixed. But in the meantime, it's created all this financial toxicity that needs to be fixed. And why should the taxpayer be on the hook for it all the time? And so I'm sitting here, like, trying not to be like complete 180 of my younger self, but like I don't disagree with, like, Janet Yellen, not John, Elizabeth Warren, or people that say, like, we should put a tax on billionaires. I don't think you should tax them 100% for anything over 100 million or something. But, like, yeah, you got to start taking wealth from these guys. I mean, they got to have it. Like, Elon, Elon shouldn't be deprived of capital. I want him to do his thing and create value if he can. But on the other hand, does Jeff Bezos need 2, 3, 500 yachts? Like, this is, these guys have benefited from the inefficiency in the system. Whether they're a cause of part of the reason, the problem in the first place, is another story. But, like, there has to be some way of fixing this. And if you just create a digital currency and you fix it through that, you haven't really solved the underlying problem. You're just papered over past mistakes. There's no guarantee that past mistakes won't happen again, which is why this debt ceiling thing drives me crazy, because they have not fixed anything. They have not fixed anything. Speaker McCarthy, again, I'm Canadian, so I don't really have any stake in this, but I don't think he's an effective leader. And the fact it took 15 votes to get him elected. And again, the biggest thing is, I was on that space call with Mario and all that, and all these experts were saying, and some of them I've read their stuff for several years. Some are political hacks, whatever. There was a bunch of them, but they're all saying, "Oh, look at the VIX is so low. A deal's guaranteed." And I was wondering, well, yeah, the VIX is low because we all know it's suppressed like crazy. But why are CDSs so elevated? Uh, and my view was, it's elevated because even if this thing was an agreement, the problem hasn't been fixed. Ultimately, you're just delaying disaster. And so if McCarthy's deal does get voted in, then again, you're just delaying disaster. But the interesting thing is, the black swan event is, if it took 15 votes to get him elected, um, there's a possibility that he can't get a vote in the House. And so that's why I think tomorrow will be very interesting, because there's a black swan potential there, and that will screw up all these talking heads in New York and Washington that were saying, "Oh, this is nothing to worry about." I would have said that, you know, 3 years ago, the last debt ceiling thing. Yeah, Democrats control the House and Senate, no big deal. This will get passed, and it did. But now we're in kind of a weird political situation. So anyway, going back to digital currency, I think it has to happen because it has to paper over all the mistakes that have been made.
No, I agree, and that's the thing. Like you've been saying, and I've been saying forever, they're still stealing billions by the day. There's still, the problem's not fixed. It's just being masked, and the crime is still being committed. The thing I think that we need to all start focusing on, and the thing that we need to all be pushing everybody, retail, everybody, these acceptance, waiver, and consent will always keep them out of our court. It will always keep them out of jail, and it will always keep them from ever admitting crimes and being prosecuted like us. Until those are abolished, it's going to keep happening.
Yeah, yeah, and it's interesting. It's a very small voice at the moment, but there's that guy running for Senate in West Virginia that keeps tweeting about shit like this, and then uh, Robert Kennedy Jr. is making noises about it on Twitter as well. So I'm hopeful that other politicians pick up on it because retail is not a small influence on this market, and if you have a significant portion of retail believing the market is totally effed and manipulated, how many times Goldman can lie and cheat and only pay a fine and no one goes to jail? At some point, there will be a social reckoning, and I think it would be smart for a politician to take advantage of that anger and make it productive, as opposed to at some point someone's going to get tired of slipping on poo in San Francisco and they're going to lose it. And you multiply that by 100,000 people all sick of shit that they don't like. Why is this happening? Why is my city just being why are people in Philadelphia taking quaaludes and lying on the streets? It's like at some point people are going to get pissed off, and so I think part of it is the financial. Occupy Wall Street was a sort of a nothing burger, but I think the next time it won't be such a nothing burger. So I think politicians need to wake up and start getting on board. So
No, I agree with you. I mean, the balls these people have, dude. Like the people have been. I'm not, saying anything. I'm not inciting violence here, but there's just been violence towards people for way less than what these guys are doing, and they're ruining lives. I mean, they're basically terrorists to the economy. They are.
yeah,
There's no way around it.
yeah.
Um, my next question here, and my last one I was going to say is what I've been saying is if they do sign this agreement, is it's going to be the death spiral for the United States financial system, and there'll be no way out of it. I mean, I don't even think a CBDC will be able to fix it because I think too many people are going to be running out of the banking sector. They're not going to be able to keep up with it no matter what, and the Treasury bonds are going to be too. Like I said, with LIBOR switch, the Treasury bonds are going to be too enticing for people to stay away. If you basically are leaving your money in a bank at this point, you're losing money. What are your thoughts on the death spiral, or do you think that I'm over exaggerating?
No, I think what yeah, if they didn't have an agreement, you'd have an instant not apocalypse event, but you'd have massive disruption to the markets. So that may have been avoided with this agreement. But it doesn't change the problem that we talked about. As I said at the start of the call, it's like it's a bogus thing because they've never adhered to it. Like if I tell my bank, oh, uh, I'm going to reduce my credit line. So sorry, I needed the money, but I'm gonna stop. I'm going to pay it down, or I'm going to make some payments on it. And then 18 months later, it's like, oh, I need more on my credit line. Why do you need more on your credit line? You told me you're going to pay it down. Well, then other things happened, and like I got in a war with my neighbor, and I had to build some walls, and I needed to buy some tanks, and so I need a bigger credit line so I can take out my neighbor. It's like, oh, okay, well here's an extra 15,000. That's all they do. And they just keep increasing the credit line. They don't actually do anything with the expenses. They're not cutting expenses whatsoever. And the bigger problem is, and we haven't touched on this, or I've touched on it briefly on our calls. The demographics do not favor this approach. You got like the population is aging, and again, immigration is offsetting this to the U.S. Thank God, but globally, demographics are not favoring like you're having a smaller cohorts entering the workforce, and they're supposed to pick up all the bills that you guys are incurring. So if you're a country like Germany or Japan, how the hell are you expected the younger people to pay for all this debt you built up? So you're going to have to keep delaying and delaying and delaying. And it gets absurd, right? Like how much debt? I think Japan's debt to GDP is like 200% or something stupid like that. It's like,
It's insane.
yeah, no, exactly. So I think this is a problem. If you keep deferring cutting spending, because there's no incentive in the short term to stop. Like if I say, oh, I'm going to cut spending, and it's like, well, my constituents, you just closed our military base. We need that base for, okay, well, I won't do that. So these politicians will never do the right thing in terms of being fiscally responsible because that doesn't benefit them in the short term. And because everyone's lives are finite, it's like, yeah, like I know longer term it's smart for us to do this, but in the short term, the status quo works for me. And this is like, yeah, exactly. I know that Jamie Dimon should be in jail, but in the short term, his bank, provides employment for half my state. So, I'm not going to do anything. And so all these morally morally difficult questions are being asked, and basically people are falling on the easiest solution, which is to do nothing. So as a result, the debt gets bigger and bigger and bigger. It's like, doesn't not a problem, because we are the US dollar and we are the reserve currency, and everyone has no choice but to use us, and we can basically issue as much as we want, and it's their problem. Well, that's what Nixon said in 1971, and he was right. 50 years later, he's still the reserve currency, but look at what's
Yeah.
going on. Yeah.
And that's the thing too, and like with the CBDCs, that's one of the reasons why they need two different types of CBDCs. They'll try and do retail CBDC, which will have a separate value from the wholesale